I haven't done this in a while, so hopefully everyone can see this now. We'll wait a couple of minutes. I think we got some more people logging on yet. How was your drive home?
It wasn't bad. I mean, it's drifting down here in the southern regions of the city. We're a little more open, but it's starting to 40th Avenue, which runs east and west, was starting to fill in. So
it was drifting pretty good right by on 13th Avenue, right by 29. For some reason, it always really blows there. But otherwise, I live in Old Fargo. We have lots of trees.
Yeah, I don't know if if we have this is coming from the south to the north. Now it'll blow all the snow the other direction in my yard. So it'll take it to, it all blew off the driveway. Now it's going to all blow back on again. So we'll see in a couple, let a couple days go by before I work too hard at moving too much snow.
Yeah. Well, we can probably get started in a minute here. Thank you to everyone joining us tonight on a not very nice night to be outside. I'm going to go over the crop insurance changes first. Then Randy's going to talk about the markets. We'll have some poll questions popping up just to kind of keep things interesting. There is a chat function on the right side of the screen. If you have any questions while we're talking, please put them in the chat box. I'll try to keep an eye on them and interrupt Randy if he gets them. But other than that, you want to get started, Randy?
Let's get going.
Okay. I'm going to shut my camera off just so the slides are bigger.
I better do the same.
And hopefully that works. I don't think it made a difference.
Nope.
Anyway, first thing I want to talk about is we have, earlier this month, we have a brand new website, a brand new mobile app, much better than what we had before. On the website, kind of the same thing we had before. We have a marketing page, a crop insurance page. What's new, though, is we have a news page now. That's going to be where we're going to put some of the more recent information. When we have USDA reports, we put a little PowerPoint together about that. We're tracking the crop insurance prices on there. The yield exclusion maps are on there, LRP changes. So that'll be the place to go to if you're looking for newer information. And then we redid the events tab. What we used that in the past for was just for our farmer meetings, our farm shows. Now we're going to update that we're going to put all the USDA report dates out there, put the crop insurance deadlines out there. Just more information for you again out there. We also have a brand new mobile app, and this is so much better than our old app. We have the ability to categorize posts now. So you can do a search by topic and just bring up just the livestock information or just the recommendations or whatever. We have futures quotes with charts that go back about a year. And we did just do an update. The futures quotes now go up for 12 months. So if you just keep scrolling to the right, you'll see those come up. The other thing we added is we do have password access. The opening and closing comments that are the subscription comments, those are on the app and accessible if you have a username and password set up. And to do that, we just have to set you up initially. Either call our office, you can text our main number, email me, whatever. We'll just set up a username and a password for you. If you're not currently getting the daily comments and you'd like to try them out, we always do 30-day trials, and we can set you up on the app too to see how that goes for you. Which brings us to our first poll question, which is, have you either checked out our new website, our new mobile app? And these are all anonymous. We can't see your answer, so.
Well, we can see the answers. We just can't see who's answering
Yes,
them.
we can't see who answered it. So yeah, so if you have been out there, thank you. And we put a lot of work into this, and we totally want feedback. If there's things you think we're missing, if there's things you want us to change, please let me know, and we'll take that into account and try to make it better moving forward. So the first thing I want to talk about when I start these is always the prices. Of course, we're in February. We're tracking crop insurance prices. If you look at wheat, I've got spring wheat going back to 2011. Last year was the second highest price we ever had for spring wheat as a projected price on March 1. For corn and soybeans was the top price by quite a bit. Corn was number 2. And right now, this is where we're sitting as of yesterday's close. I haven't got today's numbers in there yet. You can see barley's looking better than last year. Canola's a little bit lower. Corn, $5.90 last year. Right now, sitting at $5.95. That's pretty much unchanged. Oats is a brand new revenue protection crop. They moved that from the APH plan where RMA just sets a price, and now it's going to be tracked with the futures. And I'll show you the next slide how they do that. But oats, $3.70 last year. Now we're sitting at $4.35. That's a nice big jump on that one. Rye will be new for the 2024 crop year. So this September, rye will move to a revenue protection crop and have projected and harvest prices. As for the rest of them, for the soybeans were not seen as great of a price as we did last year. We're sitting at $13.76. Wheat, what's interesting about wheat, if you look at where we are for spring wheat in Durham quite a bit higher than last year, and spring wheat lower. And they changed that factor. They take the spring wheat price and take it times a factor to get the Durham price. And last year, there was only a 25-cent difference between spring and Durham. This year, as of the 21st, $1.25 is the difference between spring wheat and Durham. I'm not sure how they come up with that factor. It's 14% this year. That is a big change from where we were a year ago for those prices. And like I said, oats is moving to either yield protection or revenue protection coverage. So now we will have enterprise units available for oats. The projected and harvest prices will be based off the Chicago September wheat futures. We're not using the oats futures for these. Take it times a factor of 0.5509. Rye, when that comes out this fall, same thing. We're going to use the September Chicago wheat futures. And again, times some factor, and they have not published that factor yet. And they should have enterprise units available too, which will be nice because rye premium is kind of expensive. As for the other crops, the dry beans, of course, we have no way to track those. RMA just comes up with their price in early March. That's where we sat last year. There's the dry peas. And the APH plans, these are the plans where RMA just sets a price. Not a lot of these left. Some of the dry bean types still fall under there. Flax does. This is where we sit now. RMA can come out and bump those prices up before March 15th if they want to. Which brings us up to our next poll question. Probably apt for a blizzard question. When do you think you're going to get in the field? Not seeing a lot of optimism on this one. Not surprisingly either with the storm. So again, probably not looking at a really early start to spring, especially if the snow keeps falling the way it is. A couple other things. Now, these aren't really going to affect many of you guys, but it's out there now. It's available in our area. So I just wanted to mention it. RMA really expanded the places where you can double crop. Where your soybeans would be your second crop. When the war in Ukraine happened, they were really kind of pushing to get more crops planted in the U.S., and that was the way they could kind of push that, was to do some double cropping wheat to soybeans. It is just available for a few select counties in southeast North Dakota in this area, but you have to have 3 years of double cropping history to even apply for a written agreement, and then you have to get a written agreement for it. And on the map, those yellow counties are the ones where you have to have the 3 years of history to get a written agreement. And it's just the tiny little 4 counties in the southeast corner of North Dakota. They also are pushing relay cropping. This is where you can seed soybeans into a small grain crop. And again, for this area, you have to have 3 years of history of seeding your soybeans into a small grain and then apply for a written agreement. So again, really won't affect many people. But that's what all the blue counties are on this map. So theoretically, you could do that. Enterprise unit, nothing changed here. Just a reminder, they've really expanded this. We can do enterprise units by irrigation practice, by type, by double cropping practice, and we still have the multi-county enterprise unit, which could bring your premium down in those little counties where you only have 1 or 2 sections. EU by type, just a reminder here, this is nothing new. You can now separate enterprise units by type for dry beans, dry peas, sunflowers, and wheat. And you can kind of pick and choose what you want. You could do enterprise units on your Pintos. You could do optional units on your Navies and kind of mix and match them that way. And again, that's a sales closing decision that has to be on the policy by March 15th. Prevent plant reminders, nothing changed here. But again, a year or 2 ago, big change they made was 2 crop history is no longer needed. So now you can, if you had a 100-acre field and you planted 10 acres of soybeans, you used to have to call the rest of the PP soybeans unless you had a map that showed corn and soybeans in that field in one of the last 4 years. They took that out. So now if you say, my intent was to plant corn on that 100 acres, you can still plant soybeans where you can get in and you can still call it PP corn. Also, they've loosened up the cover crop rules. Once you have hit that final planting date and you can call it PP, you can plant a cover crop anytime after that, as long as you don't harvest it for grain or seed. They took away the rule that said you had to wait until November 1 to hay it or graze it. There is no date anymore. And again, just a reminder, there's got to be a valid cause of loss to claim PP. And they specifically said corn cannot be used as a cover crop. Which brings me to the next poll question. Do you think you'll have any prevent plant acres this year? Let me bring it up again. Got some optimists in the room here. Randy, I haven't looked at the drought monitor map. Are we still, most of North Dakota is still in some stage of minor drought, isn't it?
It is. I'll have that at the end there, but we still have a little bit of drought area in the state. And then some actually getting to be a little bit more deeper soil drought starting to form in some areas too. So we're not quite out of the woods yet as far as the drought is concerned.
And we got a ways to go until we're in planting season. This next chunk is just all, reminders. There's nothing new here. Keep in mind, if you do pick up a bunch of land, if you're that fortunate, stay under 2,000 acres per county. If you go over that, you're stuck with the county TILD. If you have land coming out of CRP, first year it's insurable with just 100% of the county TILD. You can't claim PP the first year. After that, it's all normal rules. New breaking but previously cropland. The first year you plant that, it is not insurable unless you ask for a written agreement. And again, you'll get a lower yield the first year. You can choose not to insure it the first year. After that, normal rules. Native sod, this is one they've really wrapped up the penalties on this one. Native sod is acreage that is either never been tilled, so like native pasture, or you cannot prove it was ever planted to an annual crop. RMA loosened that a little bit. They said if you can get FSA to write you a letter saying, yeah, we don't think this is native sod, that'll work. But if you can't prove that it's been planted, you have to have 4 years of insuring the crop before the native sod status can be removed. cat coverage doesn't count, or you have to wait 10 years if you don't want to insure it. And this kicks in as soon as you have 5 or more acres across the county, regardless of crop, regardless of what year you broke it out. If you broke out 3 acres of native sod last year and you did another 3 this year, you're at 6 total. You're going to fall under these penalties. And the penalties are, your guarantee is based on 65% of the county tea yield. They'll take away a good chunk of your premium subsidy. And again, just like the new breaking, you don't have to insure it the first year. Land is only insurable if it has been planted and harvested in one of the last 3 years. After that year 1, though, now you've planted it. Now it has to be insured, and you have to have 4 years of insurability to avoid those penalties. The reason I bring that up like that is we don't always know. FSA doesn't even always put that on the 578s, and we want to do it right from the start. We don't want you in the situation where you get audited and then we find out, oh yeah, this was native sod, we didn't report it right. They'll have to go back and maybe pay claims back, maybe have to pay some premium back. We don't want to get in that situation, so we just want it all done at first. So make sure if you have any of those new breaking, native sod, any of that, let your agent know before sales closing, so we make sure we have that insured the way you want to. And we're up to another poll question. We have the farm, oops. I keep missing my thing to set them up. Here we go. We have the farm bill coming up again. Question is, do you think we're going to see a farm bill passed this year in 2024, or will this Congress not get it done at all? Anything to add to that, Randy?
Well, I guess I would say one nice thing is that there's not much in the farm bill that has to be approved, as most of it's already, written in the law. There's just a couple of things, but it's going to be interesting to see how this all shapes up and how it turns out with all of everybody trying to get their pet project built into the farm bill, whether it be with the conservation or whether it be with carbon credits, or whether it be with whatever the news of the day is that they're trying to get worked into this to tie it to the subsidies with and how they're working out, whether they're going to do with the ARC and the PLC. So right now the rumors is that they're going to run both programs and then pay it whichever one's going to be the highest. That seems to be the general consensus coming out of what they are looking at for the farm bill. But there's still a lot of time before this is going to be done, and just seeing if the SNAP program stays part of it, which is kind of very important to keep the farm bill going.
Okay, then we do have, of course, a very divided Congress right now, but hopefully this is one thing that a little less controversial. Maybe everyone can kind of come together and get something accomplished would be nice. Moving on, yield exclusion. Yield exclusion is the county overall had a disaster. You can take that yield out of your APH database. There's always a lag year in that. So RMA has time to get all the yield data together. So now we can exclude 2021 yields that RMA said qualified. If you choose that YE yield exclusion option, all qualifying yields are removed. You can add them back in on an individual basis. And again, just a reminder there, that larger that gap gets between your average yield with no options to the approved yield, that's going to jack your premium up. So for an example of that, on this one, on the left side there where that 29 is, that is just a rough yield. You take all those yields, divide them by the number of years, we get a 29 average yield. This is your rate yield. If we can put all of our options in there, our trend adjustment, our yield exclusion, our yield adjustment, all that stuff, we can bump that APH all the way up to a 38. Now you're going to pay for that. A 38 APH in my example here get you $262 of coverage. If you had a 38 average yield, a 38 rate yield, and a 38 approved, so you had a decent yields across, 831 premium per acre, or premium is 831 an acre. Now with that 29 rate yield, but your guarantee is based on 38, that premium is going to cost you $9.58. So just be aware of that. And that's, a lot of work what Darrell and I do in the office is kind of playing with those numbers. Maybe you're, maybe taking that yield out only gets you a bushel and it costs enough that you don't want to do it. We kind of could just play with that and try to max those yields out. And again, you might have some good yields. It's kind of hard to see in this one, but that top yield up there with that's eligible is a 32. And in this case, maybe we'd want to put that 32 yield back in and see what that does. And again, something to look at March 15th. This is why we want you to have all your production records into us before March 15th so we can run these quotes and do all these reports and make sure we're maximizing your yields. And here are the maps. The difference between the yellow and the green, the yellow counties are the primary. Those are the ones where RMA said, yep, it was a disaster. But the rule is all the counties touching those counties also can exclude their yields. And so those are what the green counties are. And again, that's why you really need to look at this, because if you're in a green county, your yields might have been fine in 2021. And if you have that YE option on there, it will automatically pull those yields out of your policy. So here's wheat, North Dakota. Here's the corn map. Soybeans. And again, Red River Valley missed most of these. It's mostly out west. There's the barley map. Canola. Dry beans. Dry peas. Oats was about everywhere. Minnesota side, there wasn't as many. We have corn in some counties. And oats again, everywhere. And then sunflowers in just a couple. As for South Dakota, these were the corn counties for South Dakota. They had no soybean counties qualified. And I did not look at wheat for South Dakota. If you are in a different area and you are interested in that, send me an email, text me, and I can look up those for you. Whole farm revenue protection, again, just mentioning this is that one where you have to provide 5 years of your Schedule F of your tax forms, and your loss is determined just on your revenue, if you hit your revenue guarantee or not. They bumped up the max allowable revenue to 17 million, took out the expense reporting. But what's new on that side this year is there's now a micro farm policy. And that's kind of for the little guys, if you're growing some fruits and vegetables or, little things that are really hard to kind of put numbers together with. All your commodities go on one policy. We don't have to list them separately. Approved revenue has to be $350,000 or less. Big difference with this one, with the whole farm. If you do have an RP, YP, whatever policy, you get a discount on the whole farm. This is the opposite. You cannot have any other federal crop insurance product if you do micro farm. We only need 3 years of tax returns. And again, the Schedule F is what we use. That's available out there. If that interests you, talk to us, talk to your agent. SCO. Just want to touch on this because this always comes up a lot this time of year. SCO is the policy where it picks up where your RP, YP, whatever coverage leaves off up to 86%. Liability, what it pays out is based on your APH, but the loss payment is based on the beginning county yield and the final county yield. And this is important why we talk about this a lot. If you have ARC at FSA, you cannot take SCO. So if you want SCO, you have to make sure you do PLC at FSA. And that's just a little kind of a picture of how that works. Your blue is your RPYP, whatever coverage. Your yellow is where the SCO up to 86%. And then the ECO goes either from 86 to 90 or 86 to 95. Those are the only two options for that part. ECO, again, that's that higher, very, very shallow loss coverage, so it's going to be more expensive. This one, your yields don't matter. It's all based on the county yields and the harvest, projected and harvest prices. This one, we don't care whether you take ARC or PLC at FSA. And you don't need SCO. You can just, if you just want to cover those really shallow losses and have a gap, you can do that. It is a bit pricey though. So these examples are, you took your RP enterprise unit coverage, then you took SCO up to 86, then you added the ECO all the way up to 95. And what I wanted to illustrate here is that if you look in the red, you're going to have the same coverage. Whether your RP is 70, 75, 80, your total of all three will always be the same. It's just kind of a question of what bucket do you want to put, what part of your loss in. So if you look at a 70%, your first 70% of coverage is costing you $534. That next 16% is going to cost you $7.96 for $121 of coverage. The ECO is $68 of coverage for $18 an acre. So you can see that it's pricey, but it's some very, very shallow loss stuff. And if it interests you, I would suggest kind of working through this spreadsheet, either with me or with your agent or whoever. Any of you put this together. So this is where you can just kind of play, put in some what ifs. What if the yield does this? What if the price does this? Just to see where the parameters are, where it kicks in. Because we don't want you to buy a product that you don't understand and that we don't want you to be unhappy at the end of the year. So we want to make sure you know how these work. In this one, I did not change the price. I just dropped the yield, and I had to go from the 38.7 was the expected county yield for Cass County. It would have to drop all the way to a 29 to fully pay out that whatever, $88 it was. If I do it the other way and I leave that 38.7 expected county yield alone and I drop the price, I have to drop the price all the way $3.44 all the way to $10.30 to fully pay out that SCO. Neither one of those are probably ever going to happen. So I can also print out for the last 20 years the history for all those. So you can look at what years had a yield drop, what years had a price drop, and then overall on that far right column, when they would have paid out. And I forgot to mention too, there's a handout section on the right side of your screen. There you can download both my slides and Randy's slides, because I know some of these get really hard to see at a smaller monitor. And we did have a question a while back, and I missed it. Said, when are they going to get corn separated from silage and grain? That is a good question. I assume you're talking about enterprise units, splitting those up between the two. We're kind of at RMA's whims of whatever they want to do. A lot of that stuff, they need to get the grower groups behind it, get some lobbying in there to kind of push some of that stuff through. Otherwise, I haven't heard anything that will be changed at all in the near future. Farm programs. We had a couple right now. The ERP, a lot of you probably were paid in phase 1 where they used crop insurance data. Phase 2 now is trying to catch the people that got missed in phase 1. This is going to use tax records. And that shows you had to have a qualifying loss in 2020 or 2021 that resulted in a decrease of allowable gross revenue. From what I've seen about that, you don't actually have to take your tax forms into the FSA. There's a worksheet you can do, and then you self-certify. Obviously, just like anything else, if you do get audited, you would have to provide them later. The PARP, this one we haven't heard much about yet. Again, this is if you had at least a 15% decrease in allowable revenue in 2020 due to the pandemic, and that one will use tax records also. And again, you've got to sign up for ARC and PLC by March 15th. And here's where we sit with the prices right now. Randy, I guess we're telling most people to, ARC is going to give you the best shot of getting a payment just because of if there's a yield drop. Price-wise, though, these prices aren't looking too good.
Correct. Yeah. Right now, it looks like, as at this point, neither one will pay. But because our prices won't drop down to the reference prices or the effective prices for PLC, but your yield could drop if something happens as far as your county production, and that would make ARC a little bit better for the major crops, for wheat, corn, the soybeans. When you start looking at it for the specialty crops or more of the oil seeds, the canolas, the sunflowers, barley, those you probably would still lean towards the PLC just because of the higher reference price.
And again, we were talking about SCO. If SCO interests you at all, you cannot take ARC on that crop. Next poll question. We had an option last year where you got some extra money if you had cover crop acres planted. That has been discontinued for this year. The money's gone. So the question is, would you plant cover crops or more cover crop acres if you were getting some more financial incentives from USDA? I know there are some states that are offering, there's some pilot programs where they're offering some money. I think, is it maybe as high as $10 an acre, Randy, in some of those, like the I states?
Yeah, some are offering some pretty good incentives to plant some cover crops, and again, yeah, that is coming from the states. Kind of unfortunate. The government kind of pulled the plug on their part of it, kind of abruptly when they ran out of money. So it kind of leaves more guys a little bit up in the air for this year.
That's again another thing with the Farm Bill. Once those negotiations start, that's another kind of just nice thing out there that can, make the environmentalists a little bit happier too, if we can throw some money at some cover crops and have hopefully some more funds for that going forward. Last thing I want to talk about really quick, I'm not going to spend a lot of time going through this. LRP is Livestock Risk Protection Insurance. We've sold a lot of this. It's been a really, really good product. RMA has done a good job of improving it, increasing the subsidies, expanding how many quotes we get in a day, expanding the weights. But just to kind of cover just a few quick things, this only provides against declining market prices. So you're just locking in a price when you book this. And then at the end of it, just like wheat or corn or soybeans, RMA comes up with a price at the end. And if that's lower than what you locked in, you'll get paid. There's no minimum number of head. This is, like I said, very nicely federally subsidized at this point. Some changes though, I think it was in 2021, they added unborn steers and heifers. So now if you own the cows, you can insure the unborn steers and heifers up to 599 pounds. And that's been a nice one because they don't split out steers and heifers. It's all lumped together. With the individual steers and heifers, there's a discount on the heifers. For feeders, it goes, there's one weight range up to 599 pounds, and the next one goes from 600 up to 999 pounds. Last year, there used to be, it stopped at 900, and we had this gap between 900 and 1,000 where neither product covered them. So they fixed that. On the fed cattle side, it's just steers and heifers. Everything just gets lumped together. And on that one, they go all the way up to 1,600 pounds. It used to be 1,400. And so they got an extra 200 pounds on the top end of that one. And this is a really different product compared to anything else in crop insurance. We get quotes every day. So every day the commodity markets are open, we get quotes. Actually, usually they're out by 3:30 in the afternoon. Those quotes are good until 9 a.m. Central the next day. At 9 a.m., the program shuts down and we're locked out until the next set of quotes comes out that next afternoon. On holidays or days where RMA doesn't have enough data, they can reserve basically the right to not release quotes for a day. And again, they've, like I said, between the subsidy increase and they've expanded how, it must be how they come up with all those quotes, because we get a lot more quotes to be used to for a lot more weeks on a daily basis. One change, if you've bought this in the past, the new changes this year, now you have to have proof of ownership before they can pay the loss payment. It used to be we'd run the report, it said you had a loss of whatever, and you just had to sign off saying, yep, I own the cattle, and that was about it. And I didn't sell them more than 60 days before the end date. Now they want to show that you actually had them. So they want bills of sale, statements from a feed supplier, a veterinarian. And there again, too, now, and it didn't matter before, but now it matters. If the average weight or the number of head is less than you booked, they will reduce your claim payment accordingly. You don't have to sell them by the end date. You can still hold on to them. That hasn't changed. You just have to have some kind of documentation that shows that, yes, you owned them, and yes, they hit the weight that you had booked them for by the end date. And again, vet records, a note, a letter from your vet that's signed, that'll work for that. So their example here was you insured 100 head at 700 pounds target weight. They hit the weight, but you only had 95. We had some deaths in there. You will only get paid for the 95 that you actually sold. And they will not reduce your premium in this case. And this one, you booked 100 head. You wanted to get them to 700 pounds. You only got them to 525. They're going to do some math now and go down and reduce what's allowable. Now, in that case, if they were that much off and early, if there was a drought or something and you had to sell them, you had no feed for them, if you can document that, they won't reduce your coverage at loss time. And in this example, you started at 100, and because of the huge weight difference, you're going to get down to 89 is all they're going to pay you on. One more thing on that too, now they care about, again, death records. If you do have any of your livestock that die, you need to let us know, and we just fill a little form out and send it in. And then again, that will be counted against you at loss time if you don't hit the number of head on your endorsement. Randy, anything you want to add on that?
No, I mean, it's just that, I guess the big thing, right now with the way the market is behaving in the cattle and more side with the economy and how the lean hogs are going, we're setting almost contract highs daily. I'll get into that a little bit in my side of things with on the livestock side, but we've got the markets have shown some pretty good strength. There is some issues that could be coming into play here as far as the cattle are concerned. This is a good tool to use to put a floor underneath this market and keep your upside open. That's the best part about it. And it has, USDA has made enough changes to it that have made it very attractive to use because it's so easy to be able to bind the coverage and actually get that floor underneath the market.
So again, if you haven't looked at LRP in a while, if you haven't ever looked at LRP, again, shoot me an email, call our office, and I can get you some quotes to see how this product works. That is all I have. And unless anyone has any questions, I will turn this over to Randy. If I can remember how to flip this. Oops, there we go.
There we go. Okay. All right. Now it's my turn to start. So, well, it's volatility has been the name of the game as far as the commodities have been concerned, except for the last 2 months. Especially the last month, we seem to kind of run into a brick wall, and this market's kind of slowed itself down. We've been seeing some pretty tight trading ranges, but I think it's just a phase. I don't think it's something that's going to be what we're going to see moving forward. I still look for this market to be pretty volatile and for some price movement to be happening yet here as we go forward. And of course, the makeup that we've got going on right now is, of course, going on in South America, where most of the attention's being focused. we're starting to watch a little bit in our southern plains because of the winter wheat coming out of dormancy. And there's some variables here to be watching as far as all these markets are concerned right now, and how they play with each other, and I think how some are going to play against each other. But first off, we got to talk about that there's risk and involved. So that's the disclaimer we have to put out. Looking, I guess it's Amy's turn already.
Yeah, I'm sneaking those in on you. This one, we're curious, how much of your 2022 production have you sold? Looks like we got some guys with a way to go, Randy.
Yeah. So, I mean, that makes it interesting. Is it depends on the product. I would agree with those levels, some of those levels in some markets. In some markets, I think guys should be a little more aggressive, and then we'll kind of talk about that as we get going. But kind of to build it up to how we got to where we are and what's going on, and that is, back in 19, we had a huge prevent plant year. Fell down. We planted a little bit more of the crop in 20. 21, we had again a really good planting season. The way things were looking as we were going into the spring of 22, it looked like we were going to have another good year, going to get into the fields early. Well, then even with the snow that we picked up in December, by the time we got into March, we were starting to hear reports of crop planted out in the western part of the state at the end of March, and things looked like we were going to be moving along pretty good. Well, we flipped the calendar over to April and things started to change pretty rapidly. And then it was the end of May and in June before we got back into the fields. Miraculously, we were able to come in with a pretty decent crop, or at least better than what most had anticipated. But that started this market on its bull run, is the fact that we started to see a little bit more prevent plant than what was anticipated by the trade. You look at it as far as the states are concerned, it was North Dakota, Minnesota, and South Dakota who led in the prevent plant, primarily North Dakota, northern parts of South Dakota, and of course western Minnesota is where most of the prevent plant acres came into play. And it was not expected by the trade at first. And when you look at it, most of the trade was expecting, since we had 317 million principal acres planted in 21, most were looking for us to go back to that 319 that we saw in 18. We were actually looking at picking up the 2 million acres. Well, instead, we dropped down to 312. So that took that 5 million acres out of production that we were expecting to gain, actually 7 million. And that added to a little bit of the bullishness as far as the market is concerned. Of course, you throw in some other aspects that happened at the same time frame. One of them is the fact that we have extremely strong exports. When you look at it, or on the export side of the market, you look at from the beginning of January to the end of December, we set records as far as our exports were concerned. For 2022, the biggest crops we were exporting were soybeans, corn, and beef. That's the three biggest products that we export. And our biggest sources, or our buyers, were China, Canada, and Mexico, and followed by Japan. What makes it interesting is the difference that you see. I know this is kind of hard to see in your screen, but China comes in at about 36 billion. The next closest is Canada, and I believe they're 26 billion. So a good 10 billion between them. Mexico is pretty close. But then the fourth goes to Japan, which is another 10 billion down. So we've got a definite division between 1 and 2 and between 3 and 4 as far as our demand is concerned. Inflation was another big thing that came into play as far as the market is concerned. We started to see tighter supplies, logistics, supply chain issues sent all the markets sharp, or a lot of the inputs and a lot of the the secondary markets sharply higher, and we started to see our inflation increase, which has caused the Fed to come in and increase interest rates quite a few times. And at this point, the way things are looking, we're not done seeing those interest rate hikes. It's likely we're going to see at least another 2 points, another an increase of over 2 points yet this year. And I would bet that the middle of March Fed meeting will probably see a 0.5 point increase because of the fact that our PPI and the CPI, along with the unemployment staying so low, those three things I think are going to force the Fed to make another 0.5 point increase in the middle of March, which that isn't going to be taken very well as far as the market is concerned from what I see and from what I've been reading. The other part, of course, is you throw in a little bit of a military skirmish in Ukraine, and that also added quite a bit of push into this market. And the first year was bad as far as Ukraine was concerned when they looked at the war. But now it's going to get to become even worse as they get a little deeper into this, because now all of a sudden the availability of getting product or inputs is becoming harder, more difficult. Getting the crop off is more difficult. Getting it to town is more difficult, and getting it shipped out. So we're going to be looking at further cuts as far as production is concerned for Ukraine going forward because of the issues that they're seeing as far as the war is concerned. Now, looking at it as far as the crops, when you look at it, all of it in the big picture, orange juice led the markets higher by about a 42% increase in price. But what's interesting is when you look at some of the other markets, corn was up by about 23%, soybeans were up 21%. Soybean oil was up good. Crude oil was up, looks like it's somewhere around just over that 15% area. Wheats were up, but they weren't up as much because they had their bigger run in 21, and they just maintained themselves in 22 because of the Russia invading Ukraine. They got a little bit more of a push a little bit sooner. Spring wheat was actually only up by about 4%. But the markets that didn't see any increase, it was feeder cattle, which saw a little bit of a decrease. And then we saw copper and lumber decrease. And that's mainly because we started to see the interest rates hike and increase, and that pulled back a lot of the domestic spending, a lot of the infrastructure, a lot of building. And that saw those markets crumble and actually get a little bit more back to a normal area. But when we went into December, we had the market sitting at some pretty high levels. I mean, when we finished the year in 22, we had March soybeans closing out the session at the highest that March soybeans have ever traded at and closed at for that contract. So we had some pretty good push as far as the markets were concerned. But then we kind of ran into a little bit of a buzzsaw once we flipped the calendar over to January and we started to see some selling hit the market. First couple of weeks, we saw some major pressure and a sell-off hit the grains. And it was slowed down by USDA's reports that came out in the middle of the month, which was kind of a surprise, as everybody was expecting that we were going to see an increase in stocks, we were going to see a increase in production, and our ending stocks were going to see a little bit of an increase, not just what we had in the bin. Well, USDA came in with some different news for us, and when we saw the quarterly grain stocks report, it showed that we had much tighter stocks than we had anticipated. Corn stocks came in 344 million bushels below expectations and 833 million bushels below the previous year. When you look at soybeans, we were down 110 million bushels from expectations, 130 less than the previous year. And even wheat came in 64 million bushels less than expected and 98 less than the previous year. So every market had tighter stocks than anticipated by the marketplace, which meant one of two things. Either the crop wasn't there or our demand was much better than we anticipated. Well, as we saw from USDA's production numbers that came out later or with that same time frame that the quarterly grain stocks did, we saw the final production estimates come in, and they did cut production for corn and soybeans much more than anticipated. So this kind of helped start or kind of push these markets a little bit more after the first of the year. Now, what we're looking at for tomorrow, the Ag Outlook Forum is having their meeting. They're going to come with their estimates for where our acres are going to be at. That report's going to come out at about 8 o'clock tomorrow morning, Central Time. And at this point, the only thing they're going to come with tomorrow that's going to be of substance is going to be the acres. On Friday, then they're going to come with the rest of the supply and demand tables. But right now, the expectations for wheat acres are coming in at about 48.5 million. That's up 2.8 million from the previous year. Corn acres are expected to come in at 90.9. That's up 2.6. Soybean acres are expected to increase So you're looking at some more acres being planted to these crops. Now, some of this is going to come out of prevent plant, which, like I said, we had 7 million more than we anticipated. But add the wheat, the corn, and the soybeans together, just those crops alone are looking like they're going to be almost take up what we put for prevent plant from last year, plus having to get those other acres that we didn't get to get back to the 319 principal crops. Right now, the trade is anticipating just for these 4 major crops, 239 million acres being planted versus 235 from the previous year. So it's going to be interesting to see where these acres come from, what market is going to give up acres. And at this point, with our stocks, even where they're sitting at, wheat, corn, and soybeans can't give up acres. And we did see that this last week where soybeans finally came to the table saying, hey, wait a minute, our acres are starting to slip away. Corn is right now a little bit too attractive. It's gaining acres. We need to do something to get acres. And last week we saw November soybeans trade higher while the rest of the markets were steady to a little bit lower. So we're already starting to see a little bit of that acres race take place as far as the commodities are concerned. Now, looking at it as far as wheat.
I know I'm going to ambush you again.
Okay.
So, since the durum price is $1.25 over the spring insurance price right now, are you tempted to plant any durum this spring?
Boy, some guys were quick to answer that question.
Which is kind of a misleading question because you may be in an area that just doesn't grow durum, period. But yeah, no one's taking it from the durum, Randy.
Nope. But what is interesting, I mean, like when Amy brought that up, we are going to see some spring wheat acres drift over to durum because of the price. Now, it likely is going to be north central and northwestern North Dakota. We'll see some in south central North Dakota where there'll be some durum acres there with some guys that have raised durum in the past and have some history built up. But we likely will see spring wheat acres get lost and durum will capture some of those. So just not this crowd. Okay, now looking at how these numbers came out, this was actually from the January report for wheat. And what USDA came in and did, we did see a decrease in the old crop numbers by 29 where we lowered our feed. But everybody was expecting stocks to increase in wheat. So this actually came in about 15 million bushels less than anticipated. It was a cut of 4 million from the previous week. So this is starting to show that we don't quite have the wheat production or the wheat bushels that we are anticipating in January. Of course, USDA came in and made some minor adjustments as far as the February numbers were concerned, just some tweaking more than anything. Food demand dropped and then seed demand was increased because of the more acres. But what does that all show us in the big picture? It shows us that our stocks right now are sitting at about 568. Some of the lowest stocks we've seen and this goes back to 2015. So we're actually sitting fairly tight as far as our stocks to use ratio is concerned, actually the tightest in 14 years. That's friendly as far as wheat is concerned. But now when you throw in the added acres into what USDA is anticipating and where we see a little bit of demand issue, it looks like our stocks could increase back up to 729 for 23-24, which takes a little bit of that bullishness out of the wheat market. Now, it's likely we can see a little bit of pickup in demand depending on how this Russian-Ukraine skirmish continues to go. But, we're looking at the year anniversary coming up in the next couple of days, I believe it is. And it's likely Russia is going to make a pretty good push to flex their muscle, you might say, and start ramping up their missile attacks. And then that we're also looking at it where they're starting to negotiate the continuation of the Black Sea export initiative. And right now, it does look like Russia is not very much behind it. And Ukraine is trying to push for a few more concessions. We'll see what happens, but Ukraine wants this agreement to be extended for a year, and they want more people to come in and help do the as far as doing the inspection so that they can get the ships moved faster. Russia doesn't seem to be too thrilled behind this, but we'll see how it all comes into play. The deal expires on March 18th, and that's when they need to have the new deal going. Our exports for wheat are the lowest we've seen in 40 years. We're also looking at a very poor winter wheat crop, even though we're looking at higher acres. So it's going to be interesting. Wheat's got some things that's got to go through here in the next couple of weeks. I am actually friendly to the wheat market right now because of some of the stuff we've seen. When we look at the winter wheat acres, as I said, we've got a lot more acres than anticipated. We're actually looking at about 2.5 million more than anticipated of all winter wheat planted, and close to 3.6 more than the previous year. So we're looking at all winter wheat acres coming in at 36.95. Hard red winter wheat is up almost 1.5 million from above expectations, 2 million above last year. And then the soft and white wheats are seeing a little bit of increase as well. But we're seeing this mainly because of last fall when the winter wheat was being planted, they had a record winter wheat base price for insurance. And that is why we saw quite a bit of winter wheat planted. We're also seeing it because the government gave them an incentive to double crop. Remember when the Russian war started, the battle cry was that we're going to run out of wheat and that we needed to encourage wheat acres and more production. So the government was looking at doing or helping to double crop, and that's why parts of North Dakota now are eligible for double cropping. Well, they've got it now, so basically anybody south of I-90 is going to be able to double crop harvest their wheat and go in with either sorghum or soybeans. And they're going to be paid an incentive to do that. And that helped to encourage planting of a lot of these winter wheat acres, which I think are just going to basically be abandoned acres once that starts coming out of dormancy. Where you look at where the increase was as far as acres are concerned, the biggest increase came in Texas, which is also the driest right now and had the biggest concerns. They increased by 26%. Kansas, which is the biggest state, only increased by about 3%. So you think there is going to be a little advantage of let's plant the wheat. If it fails, then we'll go in with cotton or with sorghum or some other crop. We'll double crop. And I think that's kind of the battle cry that was being waged last fall for the winter wheat. It is the fourth year in a row where we've seen higher winter wheat, planted winter wheat acres, actually getting back now to where we were back in 2015. So we've actually increased them quite a bit. Last year, harvested acres dropped because of a little bit of a poor crop, and we'll see if that gets to be the scenario that plays out again this year. When you look at the conditions, like I said, not only were we looking at our exports being poor, but our conditions are very poor as far as the winter wheat is concerned. When it went into dormancy and to where it is now at the end of January, the end of February, they're going to come with another crop condition ratings for the month of February, what the impact was. Kansas or Texas is actually reporting on a weekly basis right now. Their crop is now rated again at 14% good to excellent. It just went up on Tuesday by 3%. But they're looking at, I think it's like 15% of the crop is headed, and it's in pretty rough shape as far as what most of the reports have it. So I wouldn't be surprised to see us lose somewhere in the area of between 15 to 20% of the winter wheat crop just because of abandonment and then going to the next crop. The biggest trouble that we're seeing as far as our wheat is concerned is that we just can't get it exported. We have no interest in somebody trying to buy our wheat from us. Well, we're sitting right now at 775 million bushels is where our estimates are for exports. And that's about 10% of the world's supply of exports. We used to be the leader in exports for wheat, and now we're down at about 10%, which is we're like fourth or fifth in the list of exporters. Of course, Russia is number one. Russia and Ukraine together are about 33 to 35% of the world's wheat exportable bushels. So with this skirmish that's going on, you can see that that's kind of impacted the Ukraine's market, and thought that we could see some extra demand come our way, but that hasn't happened here as of yet. When you look at it as far as our shipments, we're at the green bars are the 5-year average. The blue line is where we are this year, and our target is the orange line. And you can see that we're at the bottom of the 5-year average as far as shipments are concerned. And when you look at sales, it's even worse. We're starting to drift down below, and it's very likely we're not going to make that 775 million bushel estimate that USDA is looking for right now, unless some things started to change pretty quick. And right now, we just don't see that on the horizon for wheat. You look at the chart, we've just been really in a tight trading range all the way back. And like I said, through December, we had a couple of good spikes in this market. now recently we've fallen back. This is as of the close of today. We're a little higher here in the overnight session, but technically it looks like we put a floor in this market. It's building a strong base. It wants to go someplace, but it just needs the news to try to get it to go there. And for new crop, we've actually seen a little bit more of an uptrend, and that's where they're starting to realize that they're going to need to add some acres or do something to encourage some sort of a change in this. And I do expect that we could get new crop back up to this 9.5 area, 960 area is where I would expect that we should be able to rally it to. Anything more than that might be a little bit tough, but I do think that the 50, 60 cents is workable in this wheat market. For corn, if anybody's got questions, go ahead and ask. I think Amy's watching that. And so, okay. It's her turn again.
Yep, I am keeping an eye on the chat. Let's see, look at the corn poll. Mexico said they were not going to import any GMO corn. Then they backed off and said they would use it for feed, but they would not use it for human consumption, which I think, Randy, that's against the new NAFTA treaty rules.
Yes.
And so do you think Mexico will back off on the banning GMO for human consumption?
And
I guess what are the penalties for not being in compliance with that treaty?
That part I don't know. I don't know what that was, what stipulations they made in the NAFTA 2.0 when they did that. But they, are very adamant. Our trade ambassadors are very adamant that, pseudosanitary reasons are not, allowable to say that we won't import a product, that they have been importing. I know Mexico has always had a problem with trying to, with the GMO side of things, but this is where I think some of the green wave or whatever you want to call it, is kind of taking things to the next level that is a little bit more wild than it should be, or a little bit, not being, not having real substance. So it's really tough. I mean, Mexico is a huge importer of U.S. corn. They import 25% of what we export. It amounts to about 500 million bushels a year. And it's very easy because it's basically us driving trucks across the border. So their idea, what Mexico's idea was, is that they were going to contract with independent growers in the U.S. to grow their white corn, the human consumption kind for the tortillas, but that would take about 300 million bushels, which is, we don't raise that much white corn in the U.S. in the first place. So they would have had to increase production of that dramatically. And so it's not really feasible for that to happen. And it's really not feasible for them to get it from any other country because everybody raises GMO corn. So they're kind of trying to beat a drum that isn't beatable at this point. And it's going to be interesting how this all settles out. But right now, the goal is that they are not going, they had a drop dead date of 2024 to do this. They've removed that date. They're still trying to move forward to get to non-GMO corn for the tortilla market or the human consumption market, but very unlikely that it'll be able to come to reality just because of the difficulties. So, but when you look at it as far as corn is concerned, what was interesting, USDA in their January report, the only reason I want to show this slide is because just how important that January report was to corn. And it kind of made things go a little bit flat as far as the corn market is concerned. We were seeing some pressure come in on the idea that we were, our exports continue to trail behind last year. We're down about 50% from last year's pace. Ethanol is trailing. So there's a couple of things in corn that aren't really that friendly, and that's the big demand side. Feed demand also is another one that's likely to see trimming because we're shrinking our livestock herds. Both the cattle market, the hog, are all seeing contraction, not expansion. Well, USDA would, because of coming in and seeing where our quarterly grain stocks report told us, they knew they had to make an adjustment to corn. So they cut harvested acres by 1.6 million acres, and that is the single largest cut that USDA has ever made that late in the growing season to any crop at all. That was a huge cut for anything, for any of the markets. Now, of course, if you take away your worst acres, you're going to increase your yield, and that's what happened. We increased the yield by a bushel, which didn't make much difference, but in the end, we cut production by 200 million bushels. That was 203 million more than anticipated by the trade. That means the trade was looking for production to increase by 3 million bushels. So now all of a sudden, like I mentioned before, you've got the market running one direction thinking you're going to see an increase in production, and you see it go the other way. You have to make some big drastic changes. One of them was seeing a big rally, or at least seeing the corn market reverse and gain some ground. We did make up for some of that when we did see some major cuts as far as the demand side is concerned. Feed demand was cut by 25 million. We did see exports cut by 150 million, which was necessary because our exports are running behind. But we did see our stocks cut by 15 million bushels, which in the big picture was about 68 million bushels lower than anticipated by the trade. So that started the friendliness off as far as the corn market is concerned. To follow up, we did see a little bit of an increase in the next report, as we did see ethanol cut in the February report, which again was needed because our ethanol production is running a little bit behind average. So I think we've kind of got things a little bit more in line as far as our demand picture is concerned. I don't expect to see much change going in the demand side going forward. But what this does tell us is that our stocks are sitting at about 1.26 billion. We're sitting at some very tight stocks as far as corn is concerned, tight enough where we can't really seem to get it. We have to kind of ration the demand at this point because our supplies are getting a little too tight. But when you look at an increase in acres that they're expecting, we're actually showing them increasing by about 4 million in this, would our stocks go up to about 1.8. So we get a little bit more comfortable as far as our stocks are concerned if everything follows through perfect as far as production for 2023. And this is using, like I said, a little over 3 million acre increase in planted acres and a yield increase of over 8-9 bushels. So a lot of things have to line up perfect for that to happen, especially when you look at where the drought monitor is and where our dry conditions still continue to hold. For this scenario to play out, which is an increase in acres and an increase in stocks, for 23, we need to see quite a few things happen. The first one, though, is needing to make sure we secure those many acres. When you look at those harvested acres that were cut, majority of them were in the Western Corn Belt because of the dry conditions. When you think about it, Nebraska is like number 4 in the nation for acres for corn, and their harvested acres were trimmed by 480,000 acres. That's quite a cut. Most of that because of the drought situation. They picked up a lot of snow and a lot of some rain, so they've kind of come out of it a little bit. But you go south of there, and they're still very much in the drought situation or drought concerns, and even into Colorado a little bit. So production came in at about 13.7, quite a bit shy of what was anticipated earlier in the year. We were looking at close to a record production. So that seemed to have changed in the marketplace pretty quick. Yields still continue to be below trend. When you look at it as far as the yields are concerned, the only areas that saw an increase in yield was the Northern Plains because of the drought situation we had in 21. We did see Illinois set a record, but nobody else around them did, except for Minnesota and Wisconsin. But for the most part, we saw some big reductions as far as yield is concerned, especially when you look at the majority of the Western Corn Belt and central parts of the Corn Belt. When you look at our major exporters, U.S., I mean, we're the blue line. So for years, we were up kind of on an island by ourselves. But then all of a sudden, we started to see some competition come into play. And in about 2010, our production or our exports took a pretty big drop. And then we've been a little bit choppy since then. The one that seemed to be able to make a little bit of a surge is the orange line, which is Brazil. And right now, Brazil is slated to be the number 1 exporter of corn in the world, overtaking us this year. This will be the first time that we've seen that happen, other than in 12, when we had a drought situation and our exports were trimmed quite a bit. And you can see the rest of them are kind of stable as far as their exports, the major exporters. Argentina Ukraine's going to drop off again a little bit more. And then South Africa is very stable as far as their exports are concerned. But these are the biggest exporters of corn in the world. When you look at who the importers are, and this is part of the reason why the U.S. saw some issues, the yellow line is Japan, and that was our biggest market. And you can see how they've slowly decreased on importing of corn. But you can see how China was non-existent until about 2008, and then they started to come into play. And then even in the COVID years here, when we saw the huge spike, and now they've kind of trailed off again a little bit because they're trying to rebuild their hog herd again too. And then the other one that's starting to come on pretty big is EU. The one problem that we see with the European Union, they're like what Mexico wants to be, and that is they do not import very much genetically modified products. And that's kind of kept our corn market out of their region. But because of production logistics and everybody kind of raising the same now, EU has become a little bit more of a buyer of the U.S. corn as of late. They're not huge, but they are in buying a little bit. When you look at it as far as corn, like we said, our corn exports have not been trending very good. We're about half of where we were last year. The green bar, again, is the 5-year average. This is where our shipments are at. Projections are getting to be that 1.9. We likely can get there, but we have to see a couple things come into play to be able to get corn to that level. When you look at it as far as sales, again, we're above the 5-year average. We are on pace to make our sales at this point. But what we need to see is China come in to be a buyer. And right now, you can see they're not normally a huge buyer until about week 22 when they came in and they made a little bit of a jump in purchases from the U.S. The next real big one comes in about week 26, which is in a couple of weeks. And all this ties together with what happens with the safrinha corn crop. The second corn crop in Brazil is 75% of the corn that's raised. The first 25% is being harvested right now, and that usually goes for domestic consumption. The safrinha is what gets exported. That's 75% that's going to be planted now. So they have to harvest the soybeans, plant the corn, and then wait to harvest that later in the fall or later in the summer. Right now, they're having trouble getting the soybeans off because it's raining in northern Brazil, and they're having trouble getting the soybeans harvested, which means that they're delayed getting the corn planted. The later they delay, the lower potential the production is going to be. So that is and also the later the harvest, which has caused Brazil or China to come in and start increasing their buying from the U.S. Now, in 2 weeks, if they don't see a change, they're going to come in and buy make another large purchase as far as the U.S. is concerned, which will help push our demand as far as corn. And that's kind of what we're waiting on as far as corn, is just to see if we continue to see issues in Brazil with their harvest and the planting, and that would bring China to be a little more aggressive buyer to the U.S. As far as Mexico is concerned, they're pretty stable. This is their 3-year average, and then where they're at so far this year. We do expect that they will continue to be on pace to make their projections this year, what they normally buy from the U.S. As I mentioned, ethanol has been jumping up and down. You can see how erratic our ethanol production has been. The red line is what we need to grind on a weekly basis to be able to make USDA's projections. And right now we're below that. We're not going to make pace at this point. So hopefully we can start to see a little bit more demand or a little bit more ethanol production. The biggest trouble is our gas demand. The blue line is the 5-year average for the gas demand from high to low. And right now, where this green line is, that shows us where this year's demand is at. And it's at the bottom end of the 5-year average, which we just returned from a trip. Took a long weekend and was out in Phoenix. And from what I see, there isn't much. It's hard for me to believe that gas demand is down with all the cars that I saw on the roads and how full the interstates were. But I guess the numbers don't lie. So what's interesting about showing this is it tells us where we're at as far as the market is concerned. I took this from a gal who tweets this No Bull, and I found this to be pretty interesting. It gives us where the December corn contract has traded from the day it's come on board online for the first day of trading to its expiration date. So it's from the very first day it traded to the very last day it's traded. And you can see that most of the years are sitting down in this kind of jumble. Well, when you look at the blue line, that's 21, and you can see our rally started just before harvest of 21, and that's when the bull market started. 22 came online about the same place, but look at how much higher we've seen the 22 contract trade above the 21 in the rest of the years. The yellow line is 23, and that again is that much above the 22, and where 24 has come online is above that. So virtually what this is telling us is that the December contract is trading at levels that we've never seen before at this time frame, and it's some pretty good prices when you look at it in the big picture. As far as Brazil is concerned, they're looking at producing about, this is their estimate, 55, I believe that's going to be 55 million acres, and they're looking at a production of just shy of 5 billion bushels. Again, most of it is just being planted. We'll see if that plays out as far as their potential is concerned. And just like in wheat, in corn, we're kind of seeing a base being built. We can get up to that 690, 693 area in there, but it seems that we stall out as far as old crop is concerned. But we can't seem to get this thing to break much below that 675, 680 area either. So it seems like we're in a very tight trading range, and I don't expect that we're going to get knocked out of that range until we either see good planting progress in Brazil and the fact that China starts just switching their demand completely over to some other supplier. So I don't look for this market to fall completely out of bed, but I do look for some pressure to come into the market short term. And we're seeing the same base being built as far as new crop. $6 is a very strong level to break above, but I do think we're going to have the opportunity to get this thing up above that 610. Remember, like I said, all the stocks are extremely tight in all of our markets, and they can't lose acres. Corn right now has got the default because it actually shows the best profitability as far as the other markets are concerned. So it's got the acres to lose, but that means it has to hold its price up to be able to hold its acres. And I think we're going to see a little bit of an acres race once we get into this later March, April timeframe. For soybeans. Oh,
Snuck
it's Amy's
another one in
turn.
there. Talking about the USDA Outlook Forum. Do you plan on increasing your corn or soybean or both acres from where you were last year? Again, got a little bit of everything out here on this one.
Yeah. And it kind of leads to what everybody kind of is expecting, though, is that, we are looking at more corn acres, and, it's likely I think we will see an increase in corn acres in North Dakota, especially the southeast corner. And I do think we'll see soybean acres increase in the more so in the central part of the state because of the crush plants coming online. And, that's the one thing about soybeans that, this gets to be kind of this is the exciting part of the what I'm going to be talking about is just what the potential for soybeans is, and it actually I hate to be sounding like it's too bullish, but it could possibly be bigger than the ethanol push was in 2008 for corn. What we're going to see for soybeans in the years to come, and a lot of that is tied to the renewable side, the green wave, you might say, that's being pushed. So looking at the numbers, I'm going to start, just going back to that January report. We did see a decrease in harvested acres, a decrease in yield. That decrease in yield was not expected in the soybeans. And when it was all said and done, we did see stocks drop by 10 million. The trade expected them to increase by, I believe it was 30 million. We were looking, it's actually 32 million less than anticipated by the trade. So, we were looking at, I think, stocks getting closer to 240 million bushels. So this was friendly to the soybean side as well. Now, USDA did come in and make a small adjustment. They did cut crush by 15 million bushels, which is surprising when you've got all these crush plants that are expected to come online, and they lowered the crush estimate by 15 million bushels. that went through to increase our stocks to 225, but we're still fairly tight when you look at it as far as the big picture is concerned. And even though the early estimates coming from the Ag Outlook Forum had acres dropping, yield is going to increase a little bit because we did see trendline yield or below trendline yields last year. But our stocks aren't increasing that much when you look at it as far as the big picture is concerned, when you look at these numbers. Again, exports continue to be fairly strong. Crush is expected to stay fairly strong. And that is going to be the drivers for the soybeans going forward. As I mentioned, yield came in below trend. That was the first time that we saw that throughout the growing season because everybody was expecting to see above trend line yields. And when you look at it, the states that saw a decrease in yield, every state saw a decrease in yield except North Dakota and Minnesota because of our drought that we saw last year. Is why our yields were up a little bit. But we saw some pretty big cuts as far as yields were concerned, with Illinois dropping 3%. Minnesota's was up like 6%. But where you see the Western Corn Belt, where the drought situation sat up, that's where we saw the biggest declines percentage-wise from the previous year. Production was expected to be up close over that 4.5 billion, and we actually came in quite a bit less than what was anticipated. So we actually came in with an average production year when all things were said and done. Here's where things get a little bit interesting when you look at it as far as soybeans are concerned, is when you start talking about the crush side of things. Now, the gray line is where we've at for our record crush numbers. When you look at as far as the black, that's where 2020 came into play, and you can see the back half of the year we did see crush slip off a little bit from the record paces that we saw previously in the year. The blue line is where we were in 21, and again, they stayed fairly close to record levels for most of the months. So far now, the red, we're staying pretty close up to the top end of our crush estimates as well. So crush has been pretty aggressive as far as the soybeans are concerned for the last year and a half, 2 years. Exports have been fairly good. What surprised me is USDA in January lowered the exports a little bit. I didn't see that that we should have lowered our exports for soybeans. Well, when you look at it as far as the exports are concerned, 60% of the U.S. beans go to China. 60% of the world's beans go to China, for that matter. So, I mean, they're a huge purchaser of beans. Our next closest is Mexico at 7%. And so, again, it's not even part of the equation when you talk about as far as exports are concerned for soybeans. And China has been a consistent, huge buyer of our beans all the way back from the beginning of, especially for the last 4 or 5 years. They've been very aggressive buyers of soybeans. When you look at our export pace, again, the green is the 5-year average from our high to low. This is where our shipments are at. We're right in the middle of the 5-year average. Very, very easily, we're going to make pace that's projected as far as USDA is concerned. Sales, again, same scenario. We're very much on track to go above the projection pace that USDA is calling for. When you look at sales to China, we're in the top end of the 5-year average. We're about ready to level off, because that's about when the time that Brazil steps in and takes away our exports, and we're not very far away from that leveling off to take place. So I would expect that we would see a little bit more of a surge or a little bit more sales take place to kind of make up for a little more time before Brazil starts to get deep into their harvest. Now, looking at Brazil, they're expected to plant 105 million bushels. Remember, our production or our acres planted are closer to 88 to 90, and they're planting 105 this year, and they're looking at about a 5.5 billion bushel production. That's estimates right now. The crop isn't as good as what they're expecting at this point. When you look at the production side, Brazil is by far the world leader in production for soybeans. U.S. is number 2. Argentina is number 3. When you throw in all the other countries, they come in actually number 3, but then Argentina. But Brazil and Argentina have 2 different purposes of what they raise beans for. Brazil raises beans to export them, the whole bean. Argentina raises the soybean to crush them and then to export soybean oil and to export soybean meal. And that's where the U.S. can now come in and fill some of that gap, because Argentina's crop looks like it's going to be about 20% less than the first estimates, possibly 25% less. Well, that'll bring some extra soybean meal and soybean oil demand to the U.S. as we fill the void that's going to be left by Argentina not being able to make their commitments. you look at exports again, right now Brazil is the number one exporter, U.S. is number two, and again, like I said, Argentina does not export very many whole beans at all. When you look at the ending stocks estimate, Brazil sits on the most, Argentina is number two, and then the U.S. is sitting for one of the only markets. We are not the holder of beans as far as the world is concerned. It's Brazil and Argentina. And the reason they hold their beans longer and in storage more is because their dollars do not have value. And their inflation is bad. The beans actually have more value than their currency does. So they'd rather have the beans to trade for product than having dollars, which are virtually worthless. So that's part of the reason why you see them hold quite a bit of production. What's interesting is when you look at Brazil, just how vast that country is. They're made up, they have about 2.1 billion acres in Brazil. 65% of that is virtually tied up in natural cover and well, 69% between cities and Amazon rainforests and areas that you can't get to very easily. But 23% of their cropland, or about 490 million acres, is in pasture. Right now, 148% or 148 million acres, or 7%, is actually being farmed. The estimate is that they're going to start, because they're not looking at tearing up any more of the rainforest or any more of the shrubs in the parts of the Amazon. They're going to the pasture and they're tearing up a lot of their pastures. And the estimate has that they'll be able to take out about half to a third to half of their pasture land and add that to their agricultural land, which means they could add another 200 million acres onto their farmable production and bring it into cultivation that is of decent land. So right now, Brazil has the capacity to expand, and it looks like that's the route they're taking, is expanding by tearing up some of their pasture land. Which leads us to what's kind of the next big thing as far as the soybeans are concerned in the soybean oil market, and that is the renewable side. What's interesting is the EPA, with their renewable fuel standard, did not come with much of an increase as far as showing with biodiesel or with the renewable diesel or with the sustainable aviation fuel. Those weren't part of the equations for the RFS, and part of that is because government never really projects what's going to happen. They always forecast after the fact, and this hasn't started to come into play yet. But we are starting to see a lot more emphasis being pushed towards, of course, the renewable side. And a lot of this is being driven by California, whether we like it or not. And what's interesting, 18 other states have now signed on or signed up along with California to start pushing more renewable fuels. And the biggest drive behind this is the need to go to carbon neutral. When you take, and these aren't accurate numbers, but it's in the comparison is what I'm trying to, the point I'm getting across. And that's when you take fossil fuel, diesel fuel made from fossil fuel, you have a carbon score of 100. When you take renewable diesel fuel from soybean oil, you have a carbon score of 38. Well, if you're a big oil company or a big trucking company, wouldn't you, and you've now committed to going to carbon zero by 2030, wouldn't you rather start at a carbon score of 38 than a carbon score of 100? And that's the big push towards the renewable diesel. And we have to understand the difference between renewable diesel and biodiesel. Biodiesel is taking the soybean oil and adding it to the diesel fuel. Renewable diesel is taking the soybean oil, refining it to such a degree that it is diesel fuel when it is done. So it's taking 100% soybean oil at the start and coming out with a 100% diesel fuel at the end. Right now, these 18 plants that you see are online. Crush plants are looking to come online here in the next few years. The only difference is this number 8 actually jumps the river and it come over to North Dakota. That's actually now a Grand Forks plant. So North Dakota is looking at having 3 crush plants being built in the state. Number 2, that's the one that's in Spearwood that is up and going right. Well, it's buying soybeans right now. It's going to be crushing here this fall. Every bit of the soybeans that are being bought there and every bit of the soybean oil that's going to be crushed there is looking to go to the Marathon plant, this orange dot over here in Dickinson. So all the soybean oil from that plant is going to come over here to Dickinson. All of that diesel fuel that plant's going to manufacture is being shipped to California. Now, why does that such an important factor? Well, there's about 45 billion gallons of diesel fuel consumed every year in the U.S. 10% of that comes out of California. So they are one of the largest consumers of diesel fuel. And their idea is to get to carbon neutral. So they're pushing for this renewable diesel fuel. And that's why they're bringing these plants or looking at switching this over or having the most of their fuel supplied by renewable diesel. 18 other states have also signed on to do the same thing. And that's why you're seeing these crush plants start to pop up all over. Now, not all of these will get built. Not all of this will come into play, just like the ethanol plants didn't. But you're looking at 18 new plants and this is as of October. This is actually outdated, but even using these numbers, it means that we're bringing in 689 million bushels of soybeans are going to go towards crush. If you remember back, I showed you that our ending stocks estimate for soybeans is only 210 million bushels. So if we only have 200 and leaving everything the same, and we have 210 million bushel ending stocks estimate, we add 689 million bushels of crush to it, we actually go deficit by over 400 million bushels. That means we have to add somewhere between 15 to 20 million acres of soybeans to make this scenario work. That's a pretty, and time frame is 3 years is what we're looking at for most of these plants and for this to get going. So you can see where the push is going to be coming in the next few years. It's very likely going to be pushing towards seeing more soybean acres being planted. Now, these plants are already either up and running or being expanded, and there's more that are coming on the drawing board to be built. So it's a wave that has started, but it's still in the infancies as far as getting rolling. So that's kind of the bullishness as far as the soybean market is concerned. Now, when you look at it as far as this is the same scenario played out for soybeans as what we saw for corn. And you can see the run started in 21 again, about just after harvest. And 22 is traded above all the others. 23 has been above and 24 has been above. So just like we saw in corn, our prices are much higher than what we anticipated or much higher than we've been at ever before in history for that contract. When you look at the chart, this is a nice uptrending chart line, a little different than the other ones that we've seen that are building a base. Soybeans have actually been slowly climbing, and we're actually, we gapped higher a couple days ago because of that talk of frost in Argentina. But we are sitting, right up against or close to the contract highs as far as old crop is concerned. When you look at as far as new crop, we're kind of building a base, but you can see the uptrend line here as they started to realize, hey, we need to do something about acres. We need to buy some. So they needed to bring some incentive back into the new crop price. I do think we can get above 14. I wouldn't be excited to sell new crop beans unless there is a 14 in front of it. As far as old crop, though, I think it's time to be getting rid of the old crop. And even though basis has widened out a little bit, I still think it's the timing is right to get rid of them just before South America tries to take away our exports. Then we should see this market drop down a little bit. And I do expect that we'll see it rise back up again for April, May, when we're looking to try to get those acres planted.
Last poll question of the night here. When are prices going to peak for the grains, before or after June 1? And Randy, you came up with that question, but you didn't tell me what your answer up to was.
Well, I actually think it's going to be sometime around that June 1 to middle of June timeframe. I would expect that we will peak out our markets. And if weather can, and that's barring perfect weather, good growing season, good planting season, I think we could see these markets peak out. Now, again, we need to get acres planted when we need to have the potential to build stocks for that to come into play. So, okay, let's see. Finishing things up, looking at cattle. I had to throw this in. My daughter loves Highland cattle. They're fuzzy, she says, so that's why. But looking at it, and I'm going to go through it fairly quick, but you look at the cattle on feed report that came out last month. That was a little bit friendly to the market, neutral to friendly, you could say. Placements were probably a little bit disappointing. Marketing's coming in fairly decent. Overall, it was deemed to be neutral to the market. We're starting to finally see the cattle on feed numbers below year-ago levels for the first time in like 3 years. So that is it's finally starting to show the tight supplies as far as cattle are concerned in the U.S. Placements, of course, have been all over the board, but I think our placement numbers are going to continue to decline because our calf crop is also declining. The nice thing about marketings is that they've been able to hold fairly steady for their time frame. So marketings, we've been able to keep the feedlots fairly current. This winter is going to be a little bit tougher on them. We've seen some that have been able to move a little bit sooner. We've seen a lot of, part of the reason why I think cattle haven't, we've been setting contract highs as of late, but what I think has kind of slowed it down is the fact that we continue to see herd reduction. A lot of cows coming to slaughter because of the drought situation. We've actually seen, I think it's like a 12% higher than normal cow slaughter rate. And that tells us that, we're not building the herd. And the cattle on inventory report kind of verified that, as we are looking at about a 3% lower numbers than anticipated. What really gets to be tight is when you start looking at the retain for the heifers for retention. You look at the drought side of things and you can see why we've seen cattle reduction. This was as of December 21 is on the top left. Over on the top right, you can see that as of June of 22, and the bottom one is December of 22. And right now, we're kind of sitting right in the middle of the central or the plains is where most of the drought is sitting yet. We're still seeing it impacting part of the desert Southwest as well. But this is going to continue to see some herd reduction if we don't get timely rains and better beneficial rains. When you look at it as far as the all cattle and calves, we're looking at numbers that's been the tightest, I think, in 61 years, down 3%. So we continue to see very tight numbers of cattle. Texas, which is the largest, at just about 12 million. And then you can see where the rest fall in, which is a pretty big drop for the most part. Look at as far as the inventory change from the previous year for all cattle and calves. Just about every state saw a decrease except when you get out into some of the wetter areas. Missouri, I'm surprised that actually saw a little bit of an increase, but everybody was seeing a little bit of a herd reduction because of dry conditions. And when you look at the change in the numbers, you can actually see here, it's a little blurry, but pretty much, again, it was the Western Corn Belt and the plains that saw the drop because of the drier conditions that we saw. A lot of herd reduction, even into Montana and Idaho. And right now we're starting to see it take place as far as Colorado and Wyoming is concerned too. Cows, when you look at it, beef cows were down about 4%. So we're seeing, the lowest numbers since 13. Some pretty tight numbers as far as the cow herd is concerned. Milk cows a little bit more stable, but we even did see them, they saw a slight increase overall. Heifers, everything is down, which is surprising. Even the milk cow heifers were down a little bit, but we're looking at heifers 500 pounds and over, we're down 4%. That's they're basically going into the feedlot. Beef cow replacements were down close to 6%. We're not looking at increasing any herd anytime soon, as when you see that kind of numbers of heifers going not coming into as replacements. And when you look at as far as the steers, even those numbers were down, showing us that we had a little bit smaller calf crop than what was anticipated. Right now, we're looking at the smallest calf crop since it looks like 2016, between 2015 and 2016. So we do have some friendliness as far as the cattle markets are concerned. I do think that we have, like I said, we're sitting up at contract highs. or close to them in most contracts. The April live cattle sitting close to 166, 165. As far as the October, it's right up against contract highs as well. Very attractive levels to put floors underneath and take advantage of. As far as I'm concerned, I think it's a good place to be doing some risk management, you might say. Feeders haven't seen the same kind of push. We're kind of stalling out in this market. I think the biggest wild card is what's going to happen with our economy. When you look at the calves that are just going to hit the ground for weaning, you're looking at prices up around that 215, 216. I mean, it's some pretty good levels to be selling a 600-pound calf at. So we actually have some good levels that we can lock in and take advantage of with the prices where cattle are right now. My biggest concern is that we're going to continue to see the Fed increase interest rates, especially with unemployment as low as it is. We have to start seeing a little bit of slower spending as far as the U.S. And the only way we can do that is to start seeing unemployment numbers creep up. And then the Fed might look at slowing down, increasing interest rates. But like I said, I look for a half a point in the next report, and that is going to be negative to, I think, the commodity markets in general, especially the cattle. And especially when you got pork at such low prices, the consumer is going to go towards the pork and shy away from the beef here with its expenses. Drought monitor, as Amy mentioned this earlier, this is where we're sitting at as of last week. The new one comes out tomorrow. But you can still see that, Nebraska, Kansas, Oklahoma, and Texas is where a majority of the drought is. North Dakota is still very much in a drought situation, a little less than, we're just a moderate drought, and that goes even into quite a bit into Iowa. So it's going to take a little more than timely rains going forward here for a crop. Deep soil moisture, when you look at that, you can see western North Dakota is still in a little bit of dry conditions. We're looking at even in the north central part of North Dakota, parts of South Dakota here is a little bit more moist. But you look down into, again, into the winter wheat region, and you see quite a bit of dry areas that are going to take more than timely rains to be able to pull them out of that. But you see some wet areas especially too, and that is in Wisconsin and Illinois, and then be northern Wisconsin and eastern Minnesota. So that's what I got. If there's any questions.
We do have one question that came through the chat. Randy, any comments on what the InVigor canola seed shortage will have in the markets?
Well, it will impact. And I know Canada is likely going to be looking at increasing canola acres. There's going to be a push for acres because there's a plant that's being built, and I believe it is gone forward, and it's going to be in construction up in Alberta. That is as big as the plants down here, the soybean crush plants being built in North Dakota, and that plant is basically signed an agreement with an airline to make sustainable aviation fuel. So I have a feeling we're going to see trouble as far as seed availability with canola. And I do think Canada is going to try to push acres, which is going to make it increasingly tough down here for us. So I look for some trouble coming in the long term for that. One thing about the soybeans, when I was talking about those crush plants, North Dakota produces 200 million bushels of soybeans a year. 70% of those are exported right now. These crush plants, with these three, once they're built in operation, they're going to take 145 million bushels of North Dakota's production, which means that we no longer are going to be dependent on the Pacific Northwest and exporting beans to China. We're going to be looking at domestic demand for those soybeans, which is certainly going to help stabilize that market a little bit.
Just as a reminder too, all of our slides are in that handouts tab on the top right side of your screen if you want to grab those before we sign off for the night. Any other questions, please put them in the chat. Looks like we're good here, Randy.
All right. Well, thank everybody for taking the time on this beautiful, lovely night to spend with us. If you guys have any questions that you think of, you can always email us or call us tomorrow in the office.
Okay. Thanks for coming tonight, everybody. Stay warm, stay safe. Good night.